All right, we'll go ahead and get started. So thank you guys very much for joining. Quick introduction. My name is Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. A couple things. First, we need to go through a couple housekeeping items. So I'll take care of those first. So anything you hear today is general advice. I don't know anything about you, so I cannot offer personal advice. If you are in New Zealand, you should go to our website, morningstar.com.au. You can get our FAP on our website, and also the New Zealand regulatory authorities encourage you to seek out a financial advisor if you are looking for personal advice. So great. Well, thank you guys for joining from the completely empty Morningstar office here in Sydney. I already have my first question. So David said, what no big red? So I think he is questioning my manliness by the fact that I'm drinking a white wine, but I'm confident, David. So this is actually a wine from Tassie. It's a Tassie Shardy, domain Simha. And I was thinking about that, not that you want to hear about wine, but one of my last trips before all this lockdown mess and Delta mess was to Tasmania. So they've got a cellar door in Hobart, Institute Polar. And yeah, the wine's great. And an interesting story, we met the winemaker. He's a guy from India that moved to Burgundy to become a winemaker, met an Australian woman who was there also becoming a winemaker, and they moved back to Tassie and started a vineyard. But anyway, today we're going to talk about funds, ETFs, and LICs. So even though I cannot offer personal advice, questions would be great. So I'll just hang out here as long as questions go. But we can get into the presentation first. Oh, so one thing, yeah, you can follow us on Instagram if you want. So like a lot of big corporations, we have a social media team that reluctantly gave us an Instagram account, and they say they're going to take it away if we don't get 300 followers. So everybody on here follows us on Instagram, which this is being live streamed on. You can go to Morningstar Investor AU on Instagram and follow us, and also listen to our podcast. All right, let's get into this. We have another question. Oh, that's not a question about my wine. I will get to that. Oh, so anyway, I was thinking about this. I was thinking about this domain Simha, and I was thinking, okay, that was down in Hobart. So, you know, apparently for $308, I can fly there and then get turned around and fly back. And this is, you know, my world now, 5 kilometers. So yeah, good times. All right, let's talk about what we're actually talking about. So last week, we talked about the goal setting process. So with any sort of investment, you obviously want to start with what your goals are and how you actually achieve them. So we went through those first 3 steps last week. I was joined by Shani last week. She's not on today. She's actually on annual leave, and she's studying for her graduate certificate. So she has some exams next week, which is great for her, but it means you just have to put up with me. All right, so let's talk about this 4th step. So after we've decided our goal, after we've defined what our required rate of return is to get to that goal, after we've selected an asset allocation that's appropriate to get that required rate of return, we start picking investments. And we're going to focus today on collectively managed investments, so funds, ETFs, and LICs. There's also, of course, shares that you can select, but yeah, that's a whole another webinar. All right, so let's talk about an overview of what we're trying to do. So when we talk about these collectively managed investments, there are 3 different things that we need to consider. There is, of course, no right answer with any of these, but there is a right answer to help you achieve what you're trying to achieve. So first, the instrument. So these are the underlying instruments that are held within them. We're not going to spend a lot of time on this, but they can be shares, bonds, real estate investment trusts, cash, all sorts of different types of investments. So it is important to understand the characteristics of those investments. So even if you don't want to spend all your time researching individual shares, you should understand what they are, what are the different influences on their performance, just so you can understand how these different vehicles that they're sitting in actually move. And how do you make a decision about what to purchase? Well, once again, that's your required rate of return. So the more risk you take on in terms of volatility, the more return you can expect. So that's why you want to make those decisions about asset allocation. Well, we're going to talk about these second 2 points today, strategy and vehicle. And so something that's important that I think is misunderstood is that from a strategy perspective, We can go active or we can go passive. So of course, active is there is a person or potentially, in some cases, a computer, a quantitative decision on what to buy, but somebody's deciding what goes into this investment vehicle. Passive, of course, is tracking an index. Now, there are some gray areas between the two. And the gray areas really revolve around some of these indexes that are quote unquote an index, but not really. And we'll get into that. A lot of those, some ETFs in particular are following interesting indexes. So technically they're tracking indexes, but some of these thematic ETFs, which we'll get into. So how do you decide between active and passive? Well, I think a lot of people think that this is a one-off decision and you were either an active investor or a passive investor, but you can create a portfolio that has both. So one thing you do want to look at is you want to look at the characteristics, and we'll talk about this today, of the asset class you're trying to get exposure to, and think about what works best. And there can certainly be opportunities where you could use both, where you could invest a lot of your allocation in a passive fund, perhaps, and then find something active to supplement that. Then the last thing is the vehicle. So ETFs, funds, and LICs. So once again, a lot of people think that they have to pick one, perhaps, and that this is what they do. They're an ETF investor. We see that a lot right now. ETFs have done a great job of marketing themselves. Funds, in my opinion, in Australia have done a pretty poor job of providing easy access for investors. But there are different circumstances that matter for each one of those. So we'll spend some time going through those tonight. All right, so let's do a brief overview of all of the different vehicles. All right, so first we'll talk about ETFs. So an ETF, an exchange traded fund, it does what it says it does. So it is very appropriately named. It is something that trades on an exchange. And we'll get into why that's a good thing and why it could be a bad thing, depending upon your approach. But you can have all sorts of different assets in an ETF, shares, bonds, et cetera, everything under the sun. You can have, and a lot of people, I think, once again, this is a misnomer that ETFs are passive, but there are active ETFs as well, a number of active ETFs, and there's been a lot of growth in the active space. So once again, that's managers that are picking the securities that go into that. And what we've seen, because particularly in Australia, because of the difficulties of accessing funds with high minimums, with the fact that you generally have to fill out a lot of paperwork or go onto a platform, we have seen a lot of fund managers basically create a replication of that fund in ETF form. And I should not have put that there. So we'll just ignore that. All right, so let's talk about funds. So a fund is a situation where there is a pooled amount of money. It is managed by a manager, but there can also be active and passive funds. So something important to remember, that if you're making an active passive decision, you are not necessarily picking an asset class. And we'll get into some of the specifics around funds in a second. And a LIC. All right, most LICs are active. So something important to remember, that is the one difference. So a listed investment company. So once again, listed means that it trades on an exchange. So just like an ETF, you would buy a LIC through your broker. There can be all sorts of different assets in it. So shares, bonds, et cetera. And we'll get into some of the specifics of LICs. But those are the three things we're going to talk about tonight. All right, but the first thing before we get into those actual instruments, let's talk about active versus passive. As I said, a lot of people think that this has to be a one-off choice that you make. The history of sort of active versus passive is that active was the prevailing way to invest, and Vanguard was not actually the first company to come out with a passive fund, but they were the first company to really make it popular. So John Bogle, who was the CEO and passed away a couple of years ago, was the CEO of Vanguard, really popularized the investment approach. And what passive has done is slowly taken over a lot of the market. So almost 50% of funds now invested are invested passively, once again, tracking an index. And the appeal to passive, and what John Bogle talked about all the time, when he was building up Vanguard, who is now a giant fund manager. What he talked about all the time is that active did not outperform the market, particularly when you took fees into account. So active fund managers used to, and some still do, charge very high fee levels. Now, the competition from passive and the fact that so many funds flowed into passive has actually brought those fees down significantly. So it is a benefit for all investors of passive. But pretty simple approach. What passive represents, if we're talking about wide-ranging indexes, what passive represents is average. Remember, the index is average. So if you are a passive investor, you are getting the average minus a fee. Now, a lot of active managers have not been able to beat the average, which is where some of the problem came in. But there are some different asset classes where it makes sense, potentially, depending upon your circumstances, to invest in active. All right, so let's go through where it may make sense to take an active or a passive strategy. So the first step is, or the first thing to look at is the efficiency of the market. So this is a little bit of a complex concept, but there is a theory in investing called the efficient market hypothesis. I personally don't believe in it. I think it has largely been debunked. And the efficient market hypothesis basically says that whatever something is trading at represents its fair value based on all the available information. And then when new information comes in, the price will change. And it's kind of a convenient theory, right? Because it basically says that, okay, everything is worth whatever it's worth. And anything that happens tomorrow, any deviation in the value of a share or a bond is based on new information. The problem with the efficient market hypothesis is that it assumes a lot of things that I personally don't think are true, that a lot of people don't think are true. It assumes that we are rational, that we investors are rational, which means that we can take information and we can make a rational decision off of that. And we are not rational in anything else we do. So it's hard to believe that we're rational with investing. And I think there's a lot of evidence that we're not. And really what has debunked this is the growth of behavioral finance. That's looking at how human emotions play into decisions that you make. And those human emotions, of course, as talked about by Ben Graham way back in the 20s, was the fact of fear and greed. So those are the human emotions. But when we talk about efficiency of the market, what we're referring to is how closely a price stays towards the value. So what that means is a stock has a price. You can go on and look at a share price anytime on the internet. Then when you sit there and you look at and calculate the value, and we have one coming up, one of these webinars coming up where we'll look at how to do that, that those are essentially the same. Now, there's no way to measure this because the value of something, calculating the value of something is subjective. But the way that it is measured and the way that's measured by Morningstar is the percentage of active managers that can beat the index. So the thought is the less efficient the market is, the less that prices reflect value, the more likely it is that a manager can beat the market. So active, we want to use potentially in less efficient markets. So markets where there is a deviation and oftentimes deviation between value and price. We want to use passive in more efficient markets where there is not that deviation. So if we think about how this works in practice, if we look at markets that have a lot of people paying attention to them, the ASX 200, the S&P 500, where you have a lot of professional investors, you have a lot of individual investors paying attention to them, those generally we assume are more efficient. And it plays out when we look at the percentages of managers that are active managers that are able to beat the index. So what are examples where active has worked better? And what Morningstar does is we've gone back and we put out every 6 months a report called the Active Passive Barometer that looks at the amount of active managers that have outperformed their passive index in each asset class. So where does active tend to work? In markets where less people are paying attention. So emerging markets, small caps, which are smaller stocks, where a lot of big institutional investors can't invest because the market's too small. So small caps, micro caps, fixed income, some real estate investing, publicly traded real estate investing. Those are all cases where active has traditionally done better. Fee hurdle. So once again, we talked about this. Fees are higher for active. Those are fees that you have to overcome as a manager. How representative is the index? So this is an interesting one. Representation of the index means how big of the investable universe, of the total number of securities that can be invested in, how big is the index? So an example of this is the S&P 500 in the US is the 500 largest stocks in the US, largest companies by market capitalization. So that is multiplying the number of shares outstanding by the price. So in that case, the investable universe and the index are the same thing. Now, if we go over to fixed income, so looking at bonds, it's very different. Indexes are generally a slice of the entire investable universe. So the thought is the more choice that an active manager has, the better their opportunities to beat the index. So that's another consideration for active passive. And then, of course, how liquid are the assets? So liquidity in investing means how many people are buying and selling. So the problem is that if there's not liquidity in a market, then all of a sudden people start moving it by making investments. They're trying to find buyers if they're sellers. Their buyers are trying to find sellers because there's not as many people out there. So the problem with illiquid markets, with passive investing, is the fact that when an index changes, every single manager has to make that change. If it is difficult for them to go out there and acquire the stock, for example, or sell the stock because it's not very liquid, if you're Vanguard or you're BlackRock, you're one of these huge passive managers, and you have to go out there and buy a huge stake in a small stock, it's very difficult to do, but you have to do it to follow the market. Whereas if you're an active manager, you don't have to do anything. That you can have a trading strategy where you're looking at liquidity, slowly build a position, not trade in certain shares if they're not liquid enough. Because the problem that happens is you can move the market, literally, if you're a big active manager, because shares and bonds and everything else trades on supply and demand, right? So if you're in there trying to buy a bunch and there aren't sellers, what happens? The price keeps going up, which is not a good thing. So those are the different considerations you need to make between active and passive. So yeah, something that is a consideration before you go into any strategy. So remember, with funds and ETFs, you can go both active and passive. LICs are mainly active. All right, so let's talk about these underlying instruments and a couple characteristics to help you make a decision over what fits your personal circumstances. So once again, people sit there all the time and talk about, oh, I'm an ETF investor, I'm a LIC investor, I'm a fund investor, but it really is based on your own personal circumstances, which is what you should be considering. All right, so, and we've got equities on here as well, just because it's a good reference point for people. So I've got transaction costs. Okay, so transaction costs are what you are paying, number one, just to go on and trade anything. So a transaction cost is whatever your broker happens to charge. So of course, we know we have those for equities that we have to pay for our trades. Now there are some free brokers now, but anyway, let's just assume there's a cost. Then there's the buy-sell spread, which I think is underappreciated. So of course, that's the difference between, or bid-ask spread is what we call it in the US. That is the difference between what the buyer and seller pays. And so there will be a small spread between that. It will be larger if it's a liquid, but that's also a cost. So it's a cost of trading. So anything on an exchange, we are trading, we are paying that brokerage. So for LICs, for ETFs and equities, we pay brokerage. There are buy-sell spreads on everything. Funds, we do not pay brokerage. So it is a pain in Australia to get into funds. And I can't, like when I moved here, I couldn't figure out what was wrong with the fund industry. So in the US, for example, you buy funds with no brokerage through your broker. So if you want to go on and buy any fund, they're just all listed there. So Australia, obviously, that isn't the case. So to access funds, you have a couple different options in Australia. You can buy something like an M fund. So that is traded on an exchange. So that's through the ASX. You can go directly to the broker. You're literally filling out paperwork and going down and doing your 100 points ID at the post office and sending that in. Or you can go through a platform. So a platform will have a limited amount of funds and will have different fees. So there are platforms that you can buy funds on, but it's not easy to access. Everything else, equities, ETFs, LICs, you just buy them through your broker. But it is important to remember, depending upon how you're investing, if you are investing lots into an ETF or a LIC or an equity, which we're not really talking about today, you keep paying brokerage. Funds, you don't. So you can set up savings plans with funds where you can commit to invest $200 a month and there's no brokerage and you just continually put that money in. There's all sorts of different things you can do with funds. So think about transaction costs. So I think it's underappreciated that yes, it's a bigger pain up front to access a fund, but if you are investing paycheck to paycheck, you could save a lot on transaction costs to go into that fund. So management fees. Generally, management fees on funds are slightly more. Now, we are taking out all of the different components where active is more than passive and everything else. Why are funds slightly more? Because of the way that you invest in a fund, which we'll get into down here with this valuation method. So generally, the fees are slightly less on ETF, and LICs are interesting, which we'll get into. Those fees generally are more as well. As we get into some of the structure around LICs, we've got a little case study going for LICs in a second that we can talk to them. And the reason that management fees are generally, all things being equal, more for fund is because of this valuation method. So the way a fund works is on a nightly basis, the net asset value is calculated after the market close on a fund. So literally what happens is you wait until the market close. There's this team of fund accountants, which you're paying fees for. Team of fund accountants values all the assets in the fund. Now that can be very easy if the fund is just trading in ASX 200 stocks. It can be very difficult if there's obscure bonds and different financial instruments in there. So they total up the net asset value. That is the value that everyone transacts at on the day. So if you decide that you want to get out of your fund at 11 a.m., you don't actually know the price you're getting out on. Just like if you decide that you want to go into a fund at 11 a.m., you don't know the price that you're going in. So all these buy orders and sell orders, so they're called subscriptions and redemptions, come in. And then once they've calculated the price after the trading day, then all those transactions occur at that price. So that's the way a fund works in terms of investing into it. ETFs and LICs are different, and they're different from each other. And I'll go through a little bit of the minutia here, just so people understand how this works. An ETF also has a net asset value. So once again, the value of all the securities, all the underlying shares in that ETF. Now that net asset value is calculated constantly throughout the trading day. Now, in general, an ETF will not deviate that much from the NAV, but it can. And here's the way an ETF works. An ETF trades, of course, on an exchange, which means demand and supply, so buyers and sellers, are going to drive the price of that ETF, just like they do with a share, right? If there's more buyers on a share, then the share will go up in price. If there are more buyers on an ETF, the ETF will go up in price, regardless of what that net asset value, what the assets are doing in that ETF. But they've created a mechanism for ETFs to limit that deviation. And that mechanism is basically, and I'll get a little bit complex here, is an arbitrage that is done by trading desks at investment banks. So arbitrage means a risk-free profit. And the way they do that with ETFs is there is this notion of a creation unit. I'm sorry, I'm going to get into a little bit of minutia here. Maybe you should have a sip of wine if you're here to listen to this. So a creation unit just represents everything that's in the ETF. So in a very simplistic example, let's assume that an ETF has one security in it. So it has one share, it holds Westpac. The creation unit and the ETF are the same thing. So whether it's Westpac and there's 50 different shares in there, they all correspond with this creation unit. And at any time, certain authorized participants can exchange the share for the creation unit and vice versa. So in my example, and once again, very simplistic, let's say Westpac is trading at, and I actually don't know what it's trading at now. Let's say Westpac's trading at $50 and the ETF is trading at $50. If Westpac goes to $60 and the ETF is trading at $50, then arbitrage will happen instantaneously. Obviously, this is all done through computerized trading programs. The investment bank will buy the ETF, give it back to the ETF company, and take a share of Westpac and sell it instantly. And they'll make $10. Now, this never happens. This is happening on pennies, right? Because it's all this automatic trading. So that is what keeps an ETF close to its net asset value. So hopefully that makes sense. So it's always this opportunity that if things deviate too far away, all these different authorized participants, investment bank trading desks will come in and arbitrage away that profit. So they will keep making that exchange. My Westpac example, they'll keep making that exchange until the prices equalize. So that is why an ETF oftentimes is very, very close to its NAV. Now, a little trick for ETFs is don't buy them right at market open or right at market close, especially international ETFs. So ETFs in Australia that have the underlying securities are US or European or wherever else securities. The problem is it, like in a way, takes a little while for this whole process to quote unquote wake up. So you have the furthest deviations from NAV at open and close. So you want to buy ETFs midday. It's a little bit of a trading trick, I guess. It's not really a trick, but something to think about with ETFs. All right, so moving on to LICs, and keep the questions coming. I will obviously get to them. Just going to go through a couple more slides. LICs are very different. So LICs, once again, represent a basket of securities, a basket of shares, let's say. But a LIC does not have that mechanism that ETFs have. They don't have any mechanism to keep the price of the LIC and the price of the underlying shares in it, let's say it's shares, close to each other. So LICs can deviate significantly from the NAV. So you'll see in the terminology that's used is premium and discount. So if you are paying more, so if you're going out and buying $50 worth of underlying shares for $100 LIC cost, you're paying a premium. So you're paying 50% more. Conversely, we can have the other thing happen, right? Based on supply and demand of buyers and sellers, you can have somebody buying $50 worth of assets in the LIC for $25. Now, you have no mechanism for exchanging one for the other. So you do have to take that into account. So when you are purchasing a LIC or holding a LIC, there are two different things that you need to worry about. Number one, you need to worry about the underlying skill of the manager, right? So there is a manager that is responsible for deciding what goes into this LIC. So you need their skill, and you have to worry about the supply and demand issue that you have. So two very different things you need to worry about. So that's how all of them work from the valuation method. In terms of trading flexibility, anything on exchange, it's easier to trade, obviously, because you just have to go into your broker and trade anytime. Funds, more difficult. Minimum investment in funds is a lot higher. So depending upon the fund, depending upon the platform that you go to, the minimum investment in funds can be very high. I mean, there are funds with hundreds of thousands of dollars minimum investment. So something to think about. There is no minimum investment on an equity, an ETF, or LIC. Now, there is a probably minimum investment that you should think about. You can go in and trade one share if you want, but if you're going to buy a $20 share and you're paying $10 brokerage, that obviously isn't a very smart move. So the minimum investment has more to do with you trying to minimize the percent that you're paying in trading costs for what you're investing in. Because, of course, if you go in there, and I use a simplistic example, but you go in there and you're paying $10 on a even $1,000 trade, right? Like you are still paying a fair amount of money. You should just realize that you have to make up those returns. So something to think about there. Behavioral risk. So behavioral risk refers to the fact that as investors, we oftentimes make mistakes. So we follow the herd, we buy high, we sell low, which is the opposite of what you're supposed to be doing. ETFs and LICs and equity, certainly, because they are so easy to trade, that increases the chance that you will do something stupid. Whereas a fund, there are basically these speed bumps that, because it's difficult for you to get in and out of funds, maybe you won't do something dumb. So everyone talks about the ease of going into ETFs and LICs, but it's kind of like trying to lose weight and filling your whole apartment with a bunch of stuff you shouldn't eat. Right? It's the same thing. Like if the stuff is across the street, at least that adds friction. You have to walk across there to actually get it. So the ability to have flexible trading is a good thing. The fact that it's out there could induce you to do something bad. All right, so we're gonna move on, but I'm gonna have a sip of wine. So hopefully everyone else is as well. This is why it was good when Shani was on here last week, because when she talked, I could drink. And I know we did screw up the camera last week, that it was spotlighted on me, so we couldn't see her. She was in a different room. But every time I could see her on the camera. So every time I looked at the camera when I was talking, she was in there sculling a beer, which was exciting. All right, so let's go through a couple different case studies. So we're going to talk about LICs. We're going to talk about LICs and ETFs. Funds aren't as exciting, in my opinion. But we want to talk about LICs and ETFs. They've been in the news a lot lately. There's some interesting stuff going on with them. All right, so we're going to take the bull case and we're going to take the bear case for LICs and ETFs. So Peter Thornhill is a fairly famous investor that loves LICs. And so we're going to talk a little bit about what a LIC is and another big advantage of LIC, not just the trading of a LIC, not just the trading stuff that we were talking about before. A LIC is actually a corporate structure, unlike an ETF or fund. And like, without getting into all the legal nuances, what that allows a LIC to do is a LIC does not have to distribute capital gains and dividends if it doesn't want to. An ETF and a fund do. So what that means is that, and the dividend one is a simple one, if a fund or an ETF holds 10 shares and they pay out $1 dividend, they pass that through to you. So basically, you will get that distributed to you, anything that it pays out. Also, you will get distributed capital gains. So whether it's a passive ETF, and we'll talk about some of the downfalls of this, whether it's a passive ETF or fund or an active ETF or fund, if they have to sell a security and that security has appreciated, you get those capital gains distributed to you. And this is important when we get into the ETFs. With a LIC, the LIC manager can determine when they want to do that. So what LICs have done and what this allows them to do, and this is why they're so popular with retirees, is they can smooth out dividend payments or distributions. They're called distributions because they're not just dividend payments. And what that allows them to do, obviously, and what is very attractive, particularly for sort of retirees, is that the income is more consistent. So if you're living off of your income, or even a portion of what you're taking out of an account, you have more consistency because none of us want inconsistency. With an ETF, if you own an ETF and you're trying to live off of the income, it's the equivalent of having a job and getting a paycheck and you don't know what it's going to be. So every month you get your paycheck and sometimes it's really high and sometimes it's really low, but you still have to live off of this. The advantage of LICs is a lot of these managers spend their time smoothing these things out. So we're looking at two different years here. We're looking at 2019 and 2020. Not sure if you guys remember 2020. It was like this, but not as bad, at least in Australia. 2020, of course, was COVID year. So a lot of companies, with the uncertainty that was out there, either delayed their dividends or they just canceled their dividends. All sorts of things. It wasn't a great year to be an income investor. We, of course, saw the big four banks in Australia cut their dividends and suspend their dividends, which are a huge source of income for retirees. So it's not a great year to be an income investor. But we look at the different LICs that Peter Thornhill holds, and we look at the changes in income between these 2 years. So if you look at them, the ordinary income right here, yeah, there are some changes. Some are down, but look at ETFs. Look at these very popular index ETFs in Australia. Huge losses of income, reflecting the fact that a lot of these companies suspended their dividend or canceled it altogether. So this, of course, is the advantage of a LIC. Because of this corporate structure, the LIC manager has 2 jobs, right? They have one job where they decide what the securities are that go into the LIC, and then they have the secondary job of deciding what they're actually going to distribute. Much like a company, right? They are basically a company, whereas a company decides whether they're going to pay you a dividend or not based on how they're doing and whatever other factors they want to choose. It's a choice by management. It's the same thing for a LIC. So people really like that. And we've seen a lot of this recently. So we've gotten huge distributions from LIC. So we talk about WAM Capital and sort of what it is, but they just announced a grossed up yield of 10.1%. They can also distribute, of course, franking credits. Another reason people really like LICs. So 10.1%, which is a huge yield, especially the fact like go to your bank and see what you're going to get. So that's why people really like LICs. Particularly retirees. So those are LICs. There's some other things that we should worry about. Let's take the bear case. So we're going to look at WAM. Okay, so Wilson Asset Management is a investment firm here in Australia that Jeff Wilson, who runs Wilson Asset Management, became pretty famous, infamous, depending upon your political views, in the last election. And he sort of led this SMSF, self-managed super fund, army against Labor's policy to change the way franking credits work. So that obviously getting political. Everyone has their own different opinion on here. Jeff Wilson was a huge proponent of not changing franking credits. And of course, the Liberals won. Franking credits haven't changed. Labor dropped it from their platform. Many people blame that for the election loss. So I'm not going to talk about politics, but that's how Jeff Wilson became very, very famous, I guess, is the way that we'll describe it. Anyway, he has created this sort of loyal band of mom and dad investors, and has this huge audience. He's spoken at our conference many times. And as I said before, WAM, this LIC that he has, just paid this huge dividend, so 10%. But a couple things to think about if you're investing in something, if you're investing in WAM. So performance fees. So a performance fee is a fee that is paid to a manager, an extra fee that's paid to a manager if they beat their benchmark. So if his benchmark is the ASX 200 and it returns 10% and he returns 12%, then he's beaten that index and he gets a performance fee. Performance fees are in hedge funds. So hedge funds are very famous user of performance fees. So what they used to say is a 2 and 20. So 2% is what you're paying every year in a management fee. 20% is you're paying 20% of any profits past whatever that benchmark is. Now, the one thing that's very suspect about WAM, I'm trying to think of, choose my words there, is the performance fees are only calculated on that year performance. Now, the industry standard is that you take a 5-year performance. And the reason you do that is this following scenario. So let's say for 2 years in a row, the ASX does not move. It is flat. So it can move across the year, but at the end of the year, it's flat, 0%, 2 years in a row. Year one, WAM goes down 5%. Let's say it went from $100 to $95. He, of course, would not get a performance fee, right? Because it went down 5% and the benchmark was flat. The next year, WAM goes up to $100. So that's a 5.3% increase. Now, in this case, the ASX 200 was flat, so he beat it. 5.3% versus 0. So all of a sudden, he collects a management fee. Now, the problem is, what do you get as an investor? Nothing. You get the same thing that the ASX did. It's still flat. And that's why generally what funds will do is they'll take a longer period of time, a 5-year period, to calculate these things. So something to think about. The other thing that's interesting is the marketing that WAM does is if you go and you look at their investment performance, they take out expenses, fees, and taxes, which is not something that anyone else does. You are supposed to, well, you're obviously not legally required to do it, but you should report performance that your investors get, not some hypothetical performance that the underlying fund gets. I want to know if I'm investing in something, what would be my performance if I was invested during that time period? So yeah, it's inconsistent with industry best practices. It's misleading, frankly. So something to think about. The other thing that we need to worry about with LICs is, of course, this premium and discount. So this premium discount, basically this you're trading for more than the assets are worth, is something that has to do with the popularity of LICs. LICs have become very popular lately. So once again, this is people chasing past performance. So they're looking back on that same slide that I put up, looking at 2020 and how a LIC did versus an ETF in terms of income, and everyone's going into it. There were big discounts in LICs. Now a lot of them are getting closer to net asset value. Some, including WAM, are above it. So on 30th of June, WAM was trading at an 18% premium. So yeah, something to think about as well. All right, now we're going to do ETFs, and then we'll get into questions. So keep the questions coming. We seem to have a lot and a lot of comments, which will just thoroughly confuse me. So this is my little Dr. Jekyll and Mr. Hyde slide. I'm not very creative, but it's what I do. All right, so let's talk about why we like to invest in an ETF. If we go and talk to anybody, if we go on to any Money Smart website or any other website, talk about why you would invest in an ETF. Diversification, right? It's great. So instead of me going out there and buying a single share, one trade, I can get this giant basket of shares. All right, if I invest in the S&P 500, I get 500 shares, one trade. Transparency, right? I always know what the net asset value is. Likely, we're going to be very close to the net asset value. So that's great. Low cost. So most ETFs have pretty low fees, some absurdly low fees. They're cheaper than actively managed funds, and they're easy, right? They're easy to trade because I can just do this through my broker. And now we get into this sort of Dr. Jekyll and Mr. Hyde world. So, and anyone who's listened to our podcast or frankly gone on these things before know that I have a special hatred for thematic ETFs. So I'm sure everyone's going to sit there and now write in about how great their returns are, probably except for the people on this Asian Technology Tigers ETF right now. But wanted to look at what are ETFs, what were they supposed to be, and then what they've kind of become with a lot of these marketing ploys, in my opinion, around these thematic ETFs. So let's look at a couple of these. So I picked a couple of very popular, gold and silver rated. So those are our analyst ratings on some very popular ETFs. So let's take a couple examples. So this is VTS, the Vanguard US Total Market Shares ETF. So that is the whole US market across all different market caps. So it is 3,891 holdings. That's right, you're getting diversified. That's great. So what do you pay? 0.03%. So nothing, almost nothing to get access to all of this. That's great. And I can go through all these other examples as well, but I won't bore everybody. But the same thing with each one of these. So I use a couple Vanguard, a Van Eck product, an iShares product. Then we go over here and we look at some of these thematic ETFs. Now, a thematic ETF is an ETF that may follow an index. But once again, these are these Frankenstein indexes that have been created. So it may follow an index, but is looking at a very narrow slice of the market. And the reason I call it a marketing scheme is because generally, if there's some sort of fad, they will create an ETF that follows that. So I won't spend too much time on all of these, and I won't go through this whole thing, but we do have a podcast episode on thematics on Investing Compass. But let's take an example. We'll just take that first one right there, that FANG Plus ETF, which is like the most ridiculous one that is out there. So, and I need to read this because if I paraphrase, you will not get the true sense of how ridiculous it is. So the FANG ETF follows something called the NYSE, New York Stock Exchange FANG Plus Index. And this is a quote. The FANG Index tracks the performance of highly traded growth stocks of technology and tech-enabled companies in the technology, media, and communications and consumer discretionary sectors. All right, so I guess that sounds pretty fancy, but all right, so it follows stocks of technology and tech-enabled companies. So that is literally every company. You find me a company that does not use technology. I'm using a computer right now, so this is in a camera. So this is a tech-enabled webinar. You find me a company that doesn't use technology, and I'll ship you a case of this wine. Yeah, so that's basically any company. Now, FANG, talk about diversification, it has 10 holdings in it. So that's not diversified. And when it says that it tracks the performance of highly traded growth stocks, what that means, highly traded, popular, same thing with growth stocks. So basically it's just chasing hot stocks. So FANG has done very well, but I wouldn't count on it continuing. So what do you pay? So instead of 0.03, you're paying 0.35, so 35 basis points versus 0.03. Big difference. The other great thing about this FANG ETF is that it's equal weighted, and it's rebalanced quarterly. So basically, it's just delivering you these terrible tax outcomes. And the funny thing about this FANG ETF is that there's a lot of talk on it distributed, this huge distribution. And a lot of people on some of these internet chat boards are talking about this huge dividend they got. It wasn't a dividend. So if you go look at the underlying shares that are in this, are not paying high dividends. You got a giant capital gain pushed to you. And you will get it every quarter because every quarter they rebalance into equal weighted, meaning they sell all the winners and the market's going up. Those are all companies that have big capital gains and then buy all the losers. So yeah, needless to say, I don't really like this FANG. Everyone's very into this beta shares, Asia technology tigers. Most of that is allocated to China. Anyone who's been following the news, China has apparently decided, people are surprised at this, that that some of the technology companies in China needed to be put in their place. And everyone's been shocked that they've done this, which is strange because we have, of course, a government that is basically trying to perpetuate itself without an independent judiciary or really anyone to answer to. And they crack down on companies. So I'm shocked. But yeah, that Asia ETF has gotten hammered recently. But anyway, I appreciate you guys joining. So we're going to keep up a couple more of these while we're still in lockdown. So we do these Tuesday, Thursday, 1 o'clock. And then we'll keep doing this Thursday, 6 Sydney time. And maybe in a couple of weeks, I'll get Shani back. She's off next Thursday as well for another exam. But anyway, thank you guys. And if you have any questions, just send them through to my email address. I appreciate it. And I hope everyone has a nice night.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.